You hand over your money. The bank smiles. And somewhere in a building you will never visit, that money starts working. Not for you, but against you. That is not a conspiracy theory. That is a business model. And once you understand exactly how it works, the way you think about every dollar you own will change permanently. Most people believe a bank is a safe place. You deposit money, it sits there. You earn a little interest. You withdraw when you need it. Simple, safe, responsible. But that version of banking is a story. A polished, reassuring story told to people who were never meant to understand the real one. Here is what is actually happening. The moment your paycheck lands in your checking account, the bank lends most of it out, not some of it, most of it. Under a system called fractional reserve banking, financial institutions are only required to hold a fraction of your deposits on hand at any given time. For decades in the United States, that fraction was around 10%. In March 2020, the Federal Reserve dropped that requirement to zero. Zero. That means, legally, a bank can hold none of your money while lending out the full amount and charging someone else interest on it. Your money. Their profit. This is not a secret. It is published openly in Federal Reserve documentation. William Hummel, a monetary economist who spent years explaining banking mechanics to the public, described it plainly. Banks do not lend out deposits the way most people imagine. They create new money in the act of lending. Every loan issued by a commercial bank is, in a technical sense, new money conjured from nothing, backed by your deposit as a foundation. You are the foundation. You were never told. Now here is where it gets stranger. When the bank lends out money, it earns interest. When the bank pays you interest on your savings account, it pays you far less than it earns. The national average savings account interest rate in the United States has hovered between 0.4 and 0.5% for most of the past decade. Meanwhile, banks charge anywhere from 6 to 28% on credit cards, personal loans, and mortgages. The spread between what they pay you and what they charge others is their entire empire. You are not a customer. You are a raw material. Think about what a mortgage actually is. You want to buy a house. You do not have $200,000. The bank creates $200,000, not from a vault, not from another depositor's savings, but from an accounting entry. It types a number into a screen. That number becomes real money, deposited into the seller's account. And then you spend the next 30 years paying back that number, plus interest, in real dollars, earned through real labor, real hours, real years of your life. Professor Richard Werner, an economist at the University of Southampton who studied bank lending for over 2 decades, conducted a first-of-its-kind study in 2014 where he borrowed money from a small German bank and monitored exactly where that money came from. The results confirmed what theorists had long suspected. The bank did not transfer money from existing reserves. It did not pull funds from depositors. It simply created a new deposit, typed it into existence, and handed it over. Werner called it the most important financial discovery of the modern era, and almost no one heard about it. Almost no one was supposed to. Because here is what happens when ordinary people understand this system. They start asking dangerous questions. If banks can create money through lending, why do they need your deposits at all? Why do interest rates on savings accounts stay so low? Why does the system punish savers and reward borrowers, as long as those borrowers are the right kind? Why is wealth in a capitalist society almost always generated through assets, not paychecks? The answers lead somewhere banks do not want you to go. They lead to the concept of leverage. Leverage is the weapon the wealthy use and the word the financial education system almost never teaches clearly. When a wealthy investor buys a $5 million apartment building, they do not always use $5 million of their own money. They might use $1 million of their own money and borrow $4 million from a bank. The building generates rental income. That income pays the loan. And the investor builds equity, real, appreciating equity, using mostly borrowed money. Meanwhile, the average person takes out a mortgage on a home they live in, pays interest for 30 years, and calls it an investment. It is not the same thing. Not even close. The wealthy borrow to build assets. The middle class borrow to buy liabilities disguised as assets. Robert Kiyosaki popularized this distinction in Rich Dad, Poor Dad. But the mechanics go much deeper than a self-help book. The entire tax code in most developed countries is structured to reward exactly this behavior. Interest paid on investment loans is often tax-deductible. Capital gains on long-term assets are taxed at lower rates than income. Depreciation allows real estate investors to reduce their taxable income even as their properties increase in value. The system does not just allow the wealthy to grow richer, it is engineered for it, and the bank is the engine room. Here is a number that will stay with you. According to a 2023 analysis by the McKinsey Global Institute, the wealthiest 10% of households in the United States hold roughly 89% of all corporate equities and mutual fund shares. The bottom 50% hold less than 1%. And the mechanism through which that gap was created and maintained is not intelligence, not hard work, not luck. It is access to capital and the willingness to use it the way banks use your money, against you. Now, you might ask, and this is the right question, what can actually be done? Because understanding a system and escaping it are two completely different things. The answer is not to distrust all banking. The answer is to stop using the system like a passive participant and start using it like an informed one. The first shift is understanding the difference between money stored and money deployed. Keeping large amounts of cash in a savings account paying 0.4% while inflation runs at 3 to 4% is not safety. It is a slow, invisible loss. Every year the money sits, it purchases less. Economists call this the erosion of purchasing power. Most people call it just having money in the bank. The second shift is understanding that debt, in the right form, is not the enemy. The bank borrows your money at near 0% and lends it back to others at many multiples of that rate. You can use the same logic. Borrowed capital deployed into income-producing assets to build wealth rather than dismantle it. The question is never whether to use leverage. The question is whether you are on the right side of it. The third shift is the one most financial institutions will never explain to you, because it involves leaving passive savings behind and entering the world of ownership, stocks, real estate, index funds, business equity. These are not gambling instruments for the reckless. They are the vehicles through which the wealth gap compounds, year after year, decade after decade. Warren Buffett, arguably the most studied investor in history, made a point that almost sounds simple until you sit with it long enough to feel its full weight. He said that if you do not find a way to make money while you sleep, you will work until you die. That is not motivation poster wisdom. That is a precise description of how passive income through asset ownership fundamentally separates those who build wealth from those who trade time for money their entire lives. The bank understands this. That is why it holds your money, lends it out, earns interest while you sleep, and pays you almost nothing for the privilege. And it counts on you never noticing. The system is not broken. It is working exactly as designed, just not for you. Not yet. But knowing how the machine works is the first step to deciding which side of it you want to be on. You hand over your money. The bank smiles. Now you finally know why. Like, comment, share, and subscribe IFAX Official for more updates.